Good morning. Welcome, everyone. It is Tuesday, the beginning of the week, half an hour before the market's going to open. One thing that we want to keep in mind this week is that it's a shortened week. We had a holiday yesterday. So usually when we have a holiday during the week, it takes some time for traders to come back in and volume to come back in. So we're not necessarily going to expect a lot of volume today. Another thing that started happening in the last 10 years or so is, and I don't know if it's just a California thing, maybe it is this idea of ski week. So my kids, for example, they don't have school all week because of the ski week. And I think the idea is that some families like to go skiing all week. So this was never a thing when I was a kid. I talked to some of my friends who are like about 30 years old, and they said they never had it. So it's really something that popped up in the last 10 to 12 years. And I don't know. I don't know how widespread it is yet. So that could be affecting the market as well. If that's the case, then we're going to see a lot less volume and a little bit more choppiness this week. So let's take a look at our futures, see how we're opening up, and just take everything in the context of there might be lower volume and lower participation. Okay, so futures down about third, so just at the cusp of random and not random on the S&P 500 at about 33 basis points, like really just right on the cusp. NASDAQ, we've got a little bit beyond random, so it some like comfortably in the non-random is at about 40 basis points, and then Dow at right on the cusp as well, 30 to 35 basis points. So we are definitely down, and we do have a negative bias opening up in the futures market and going into the morning session. We'll see what happens with that NASDAQ. NASDAQ leading the way down. That there was weakness last Friday, and towards the end of the week, we started seeing more and more signs of weakness in the overall markets. So we will want to watch this very carefully today on how that plays out. But before we get too excited, we want to take a higher view, more of the 30,000 foot view of what's going on. And so we'll look at our daily charts. And actually, I'm going to probably look at my weekly charts as well. So if I look in the S&P 500, we are down. It looks like we'll open right around the EMA 8. So that's not too bad. If we trade to the EMA 8 and we bounce off of it, then that's still a very strong upward trend. If we come down, well, we still have the EMA 20. Let me remove this arrow for just a moment. We still have that EMA 20 backstopping it, and it happens to be the same level as our trend line right here. So nothing to get too excited about today. If we trade down to the EMA 20 today or tomorrow, then we're going to look very carefully at putting on another hedge into our portfolios if we're not hedged already. So last week we put on a VIX hedge. We didn't put on it, but we looked at an example of a VIX hedge. And if you put that on, that may be enough to protect your portfolio already. But if you didn't put it on, or that isn't as much protection as you like, then over the next couple days, if we continue to trade downwards, then we're going to really consider putting on that hedge. And now that I think about it, we might consider putting on that hedge anyways, because we have earnings of NVIDIA coming up. But we'll talk about that in a little bit when we actually look at earnings. So the S&P 500, even though it looks like we're going to open down a little bit, it's not super significant. We're right at that EMA 8. So we really want to see what direction that it goes in. Where's my, okay, here we go. So we want to see if at the open, do we trade towards the previous close, which the tendency is. Then we get a little bit of relief of pressure right away. That doesn't mean that we can't turn around and come back down later in the day. And if that happens, then we'll be watching a little bit more carefully. It's unlikely that we'll get all the way to the EMA 20 today unless the markets are just super weak. So when we got that CPI data weakness, we traded all the way down to the EMA 20 and we recovered all in one day. Now we're at a very similar level as to right before. And for us to trace all the way down to the EMA 20, that would imply that we have some sort of news or sentiment that makes us fearful and negative to the same degree as that CPI report. And we just don't have that. If I remember correctly, all we had on the calendar were some T-bills. Yeah, just T-bill settlement, not even, okay, no, auction also. Yeah, the auction also. So really, there's nothing going on today that would lead us to say that, there's a possibility that sentiment gets that negative. So I'm not really expecting the markets to trade all the way down to the EMA 20, which means we have another day to take a look and see if we get all the way down to the EMA 20. The EMA 20 is rising, but the overall distance, let me see, I could be wrong. Could just be an optical illusion. So that was about a 2% drop last time. And now it would be about a 1.3% drop. So maybe a little bit less of a drop. So a little bit less distance to get that to that EMA 20. So a little bit easier to get to EMA 20 this time, but still not that much of a difference. So we want to check out the other major indices and take a look at the QQQ. QQQ is weaker. We did close below the EMA 8 last week, and then we're opening about halfway between where we closed last week and that EMA 20. So the QQQ does look like it's possible for us to hit that EMA 20 today. So we'll be watching the QQQ carefully. For us to break below the EMA 20 and stay there is a little bit more of a stretch, because this is pretty strong support right here, the EMA 20 and this trend line. So again, there's nothing happening today that's scheduled that could possibly give us that much of a sentiment change. So unless there's some sort of surprise news that comes out, or I guess with really low volume, we could get pushed around. But if that's the case, it's not a real move anyway, so I wouldn't be too concerned about that. We'll watch QQQ very carefully over the next couple of days to see if we do get that trend change. The Dow Jones, that's a little, we were above the EMA 8. When we open, it looks like we might open halfway between the EMA 8 and the EMA 20 though. So very similar boat as the QQQ, just a little bit stronger. So all the markets, all the indices will want to watch very carefully over the next couple of days. And that kind of fits in our timeline from last week. All last week we were saying maybe a week and a half worth of upside or sideways movement. And we did start to get some upside and then sideways movement. So this is fitting into the timeline of all the signals that we were seeing last week as well. So far, I'm very comfortable with this picture. No surprises. Everything is looking according to our expectations. And if we've aligned our portfolios appropriately, then we'll be just fine. We probably have another day to so today's session and maybe tomorrow's session to put on additional hedges if we feel like we need it. And then we'll be going into NVIDIA earnings. So I might as well talk about earnings next. Earnings. So this week, I'll sort it by market cap. We have NVIDIA earnings. This is one of the leaders, actually the leader among the Magnificent Seven that saw that amazing increase over the last year. We saw that NVIDIA from the beginning of 2023 until now was up over 400%. So a lot of people are going to paying a lot of attention to what NVIDIA does. Now, the other AI related stocks, the other semiconductor related stocks, they've been putting out really good earnings. So it would be kind of surprising if NVIDIA misses on their earnings. So I'm not expecting NVIDIA to go down or to drag the market down. So if NVIDIA puts out really good earnings and the market is down, that's going to be a really strong sign of weakness inside of the markets. And we've got to be really, really careful if that happens. Otherwise, we have Walmart, Home Depot, Intuit, Booking.com, Palo Alto Networks, so security. We've got consumer discretionary. We've got some tech. And then ADI, Synopsys, EOG is an energy. Those will be somewhat followed. And everything else is more of a mid-cap stock. So it looks like this week we're starting to shift more towards mid-cap stocks. Our large cap stocks are pretty much done reporting. So earnings will have a less and less impact on the markets. So other than NVIDIA, Walmart, Home Depot, Intuit, Booking, and Palo Alto Networks, once those are all out of the way, let's see when they report. So they'll be out of the way by, other than Booking.com, 22nd. Looks like by the 21st, which is tomorrow. So by tomorrow, it looks like the majority of it will be out of the way. NVIDIA is 21st 8 aftermarket. Tomorrow, which is Wednesday, after the market. So we'll see the majority of the effect on Thursday. Okay. So we do have today and tomorrow to put on some hedges if we need to. So once we get those out of the way, then so perhaps we get more participants back from vacation and we've got earnings, the majority of earnings out of the way, then markets can really move with very little influence of anything else. No major earnings announcements, nothing really on the economic calendar. Yes, nothing really on the economic calendar. FOMC minutes is usually a very big thing. At least it has been since Powell has come on. We've had those rate hikes and the rate cuts. There's been a lot of Fed action in the markets. And that's when FOMC minutes, FOMC announcements have a large effect on the markets. So the FOMC minutes, normally I would say, hey, let's pay very careful attention to FOMC minutes because those will reveal what the Fed actually spoke about in their meeting. I think it was last week, 2 weeks ago. So we get an inside look of what they're talking about and what their sentiment is and an idea of how they're feeling about the markets. And they're not supposed to have feelings about the markets, but it's really supposed to be about inflation and unemployment, but it's really about the markets as well. But this time around, it's going to be less significant because we already got that CPI report. And for the last month or two, they've been trying to reel in the over-enthusiasm in the bond markets of rate cuts. So they've really just been saying, hey, we've got to wait. We're not ready to cut yet. We're not ready to cut yet. We're not ready to cut yet. So it'd be really surprising if amongst themselves, they really spoke a lot about cutting rates anytime soon. And I think by now, when we look at the Fed Watch tool, we're seeing that it's much more reasonable now. The March probability of a rate cut in 0.5%, that's fine. The May probability, 32, 34, 35-ish%, which is fine. Anywhere between 30 and 40% is reasonable at this moment in time. So the markets are back to rationality, and there's not going to be a surprise that they didn't really talk about cutting rates, or if they talked about cutting rates, they're not talking about cutting rates imminently. So I'm not expecting the Fed minutes to really have a large effect on the markets. We may get a little bit of volatility, but not really a lot of directionality. That's my current feeling. So markets will get a chance to just move on their own. And if we continue to see weakness, then that's their chance to potentially test and break through those trend lines that we've been talking about. So the biggest opportunity for a break of those trend lines is we trade down to the EMA 20 by tomorrow, and then NVIDIA misses, or they say something in their investor conference that upsets people and it just breaks. So that's the biggest risk to the downside in the market right now. I don't think that's going to happen, at least not the NVIDIA part. So we may, but if that's the case, we may just come down to the EMA 20 or trade sideways. Or when we hit the EMA 20, we might trade sideways instead of bouncing. And in that case, that would be a break of the trend line as well. It would be much more mild breaking of the trend line than if NVIDIA misses. Either way, we want to watch very carefully over the next couple of days because it looks like we could come and challenge that trend line again, or at least the EMA 20. And that'd be 1, 2, 3, 4, 5. And that fifth one would be very close to the previous one. 1, 2, 3, 4, 5, actually 6. So we challenged it over here. It wasn't the trend line, but it was the EMA 20. So that's a good number of challenges to a trend line. And like we talked about last week, the more times we challenge it, the more likely it is that we might break it. So especially with a high frequency, so we just challenged it last week, and then if we challenge it again this week, then the challenges are getting closer and closer because we didn't make a new high this time before we challenged it, which means if we continue to match or underperform the previous high, then we're going to challenge this line with more and more frequency. And then eventually we'll get squeezed. Then it will become a ascending triangle, and we'll get squeezed between those two lines, and we may break to the downside as well. So it's just looking more and more like we'll get a challenge, a potential breakdown sooner rather than later. And that's nothing new. We've been talking about that for at least a couple of weeks now. But we just have more reasons to believe it now. Okay. So we took a look at our earnings, our Fed watch, our news. Let's take a look at VIX. Let's take a look at CPC. And then if there's time, there's not going to be time. In the afternoon session, we'll take a look at another potential hedge in our portfolios in case we need it. So let's take a look at our VIX. Oh, and our TLT. VIX is shooting up today. Okay, so that's interesting because we're not that far down. What was our CPC day? Or not our CPI, our CPI day. Our CPI day was Tuesday. Okay, there's this green one. So we opened here, we traded all the way up to here, and then we came back down to here. And then the next day we recovered, we came all the way back down. So we opened here, that was the equivalent of, so that was with the gap down all the way down to here at the open. And then we traded down and we traded up, and then we came back to the same place as where we opened. And the VIX, we didn't follow that same pattern. VIX was still elevated when we traded back down. But the point is, when we had that huge gap down, we were still only at 14 on the VIX. And today, we have a very mild pullback to the EMA 8. So not even below the EMA 8, and we're already up here above 15. So this market is getting more nervous, or at least the market makers are getting more nervous. So that's another reason to believe that we might be on the cusp of a trend change right here. So VIX is signaling to us that, hey, market makers are getting more jittery about they're getting more uncertain. So they're widening out their bid-ask spreads. They're widening out their pricing so that the market has to move more before they lose money. Basically, another way of saying that is they're charging more for the options so that you have to pay more money to get into the same option. So that is their way of beginning to protect themselves from potential volatility and potential trend changes. Let's take a look at CPC. CPC is down at 0.75. That's not quite at an extreme level, but it is definitely showing that there's exuberance that was building up to the long side on behalf of retail traders who usually get it wrong. And the reason why they usually get it wrong is because they're being manipulated by the market makers. So we usually wait until 0.7, but if I look, there's been a really long time since we've hit 0.7. It was all the way back here in 2021, which is crazy. So I would say 0.75 is a reasonable level because we haven't hit in almost 2 years 0.7 level. We've hit 0.75 several times, but we haven't gone much below 0.75. 0.74, 0.73. So this is an extreme enough level for me to show that, hey, our sentiment to the upside might be overdone, and we might start flipping back to the other side. And we saw that in the fear and greed index as well. Last week we were at 76, 77. Oh, previous close, just one session ago, we were already at extreme greed, and today it's showing us at 71. So the markets are pulling back on several ways of measuring it. That just tells me, hey, let's be careful. We are still in our uptrend. Our portfolios are still pointed upwards. That uptrend could get challenged in the next couple of sessions. Then we've got this big earnings event happening in the market. So the risks are piling up in the markets. We're still pointed upwards. We're still following the trend, but we want to protect ourselves because the risks are just getting greater and greater. It's like I'm driving down the same freeway that I always drive down, but now there's a thunderstorm and now it starts hailing and now all these, it starts getting super windy. The risks are just piling up for me on that exact same freeway that I drive every single day. And yeah, maybe nothing will happen. Maybe I'll, but it does mean that I should probably slow down. I should probably turn on my lights. I should probably take some precautions if I know that the road conditions are not going to be great. Maybe check my tires or whatever else that I need to do to ensure my safety to go down that freeway. And then at some point in time, the market turns around and that means, okay, I'm making a U-turn going down the other side of the freeway. So more things are piling up for me to take caution, even though I'm going down in the same direction still. So we are only 5 minutes away. Geez, I talked way longer than I expected. Only 5 minutes away from the open. So I'll leave you guys to prepare and I'll see you in the aftermarkets.